All right. Welcome, everybody, to the final week 4 of Finance 231. Thank you to Marianne, Diana, Vince, and Annette for being here during the live session. Appreciate you all being here. We want to do a couple review items from last week as far as the coursework, give you a heads up on a few of the things that are coming up this week. Primarily, though, we're going to cover chapters 7 and 8 from an e-text or ebook that, of course, you all know by now you don't have access to. However, the material will be important for the exam. The final is comprehensive this week. You have plenty of time to take it. I think it will allot you 3 hours. There are 36 multiple choice questions, so that gives you plenty of time to get through it, especially if you've prepared well. It is comprehensive. There are a lot of repeat questions from prior weeks, so hopefully after you take a test in these weeks 1 through 3, hopefully you've looked at the correct answers, and studied the correct answers after you've taken the test, so that you kind of have those in your head and take a mental note of those, so that when you see them again on the final, if you do, that you'll feel comfortable with those questions. We're going to go over every one of them now and spend probably 20 to 25 minutes today on the final exam material. So should feel very comfortable that at least you know the topics. Might take a little bit more effort, as it has in prior weeks on Investopedia or online, doing just Google searches or looking at the articles or checkpoints for the week to further your knowledge about those different topics, so you feel comfortable once you get to the test. Now, everything that you've turned into this point should have been graded. If it has not, or if it's incorrect, which I found one of those today with Marianne, so thank you for giving me a heads up on that. Every once in a while I make mistakes. They're more common than I'd like to admit, but I'm happy to correct and update things if I have made a mistake. So please review your work, review your grades, review my feedback to you. And if something doesn't make sense or you just have a question about it, please email me or contact me right away so we can get it resolved and get it corrected if it needs to be. The other thing is, and we've gone over this every week, you have until this coming Saturday at midnight to turn any of the coursework in to this point. You will not get full credit. However, you will get most of the credit. And if you want to pass the class, I strongly suggest that you get your assignments, discussion boards, and assessments done before Saturday. Now, some of you might be thinking, well, I've got too much to do. I'm falling too far behind. Even at this point, there's not any point that you should feel too far behind until we get to Saturday at midnight. I would be making any effort I possibly can, balancing anything that's going on in life this week to try and get as much of the coursework done as possible and submitted, so that I can get the grade that I'm looking for from this class, or at least a passing grade, so I can move on and not have to take the class again. So any questions about that? Like I say, no reasons for extension as far as accepting work after Saturday at midnight. That's a school policy, because I have to submit grades the next morning. And as far as coursework, I accept late work, and you can look at your grades and feedback and find ways to maybe resubmit or edit your work so you can get some additional points. Any concerns or questions about past coursework to this point? Okay, I'll take that as we're doing okay so far, or at least we know where we're at and what we need to do. As far as week 4 is concerned, you have the final test. You also have a short 15-point short answer. I don't know if you'd call it a quiz, but it's kind of a course assessment, meaning it's a way to give feedback about the class. There are 3 questions. They're short answer questions. They're worth 5 points apiece. As long as you give a couple sentences about each one of those questions, you'll get full credit. And it's really helpful to me for future courses to get feedback on how I can improve. So how I can improve personally, but also for the course. So just most week 4s, you've just got that final test or final paper and then the checkpoints. In this class and in most of the classes now, they're adding this additional, I don't know what you'd call it, short answer quiz, just with 3 short answer questions about the course and specific ways we can improve it. Okay, so that's what you've got on the docket for this week. Stay diligent with your checkpoints. As I've mentioned before, it's the easiest place to get extra points, to get extra credit if you've kept on top of those. Resubmit, edit, and turn in late work if you need to get additional points. And just make sure that you leave yourself plenty of time, of course, for the final test. Although it gives you 3 hours, and I mentioned that, 36 multiple choice questions, you could probably be done in 30 to 45 minutes if you have studied, right, and know the topics. So should be in good shape. Okay, so that's all I wanted to talk about as far as previous weeks to this point, kind of what we've got going on this week. I'd like to spend the rest of the evening, probably the next 20, 30 minutes on chapter 7 and 8. If we can get to chapter 8, I will post the slides like I have been in previous weeks, and then we'll go ahead and spend the last 20, 25 minutes or so on what you need to know for the final test. Okay, so any questions or concerns before we get started? Okay, we'll take that as a green light. That, or all of you are already asleep or have found something to watch in the background that's more interesting than what I'm saying. So hopefully you're not asleep yet. You haven't found something more exciting to watch, and we've got some interesting things to cover, and you're in good shape. Okay, so if you think of anything, any questions or concerns, just let me know. Just type them right in, and we'll answer them as I get them. So chapter 7 tonight talks about analyzing common stocks. And when we talk about common stocks, we've talked about in this course what stocks are. Stocks are an equity position, or another way to word that is an ownership position in a company. And we talked about how if you owned Microsoft stock, it doesn't mean that you have a lot of ownership. It just means that you have a very, very, very small part ownership in that company, and you get to share in the profitability of that company in the form of dividends and also in the form of value increase if the company itself does better over time. So that's the two ways that you can benefit from a stock, right? When we talked about total return, the concept of total return, we mentioned that there are two different components or parts of total return. One was income or interest, and the other is growth or value increase. Stocks have the potential to do both. Stocks can pay us dividends, which are the interest or income, and they also have the potential to grow over time, which is that value increase part of a return. We also looked at the S&P 500 returns over the past almost 100 years in a chart that we looked at last week, and saw that more than almost half of all the total return of stocks, when you talk about the Fortune 500 stocks, the biggest companies in America, comes from their dividends, so from their income. So a big portion of what they benefit us by holding stocks over the long time comes from that interest or dividend portion. So when we talk about stocks, we're talking about equity ownership in a company. We're talking about a very small equity ownership in a company, unless we have thousands and thousands or even millions and millions of shares. Warren Buffett recently has been investing in Phillips 66 because the oil industry has been so beat up and the stock has been so far down that he sees that as a good opportunity. He only buys stocks when he thinks that he's got a good opportunity to grow his money over time. Warren Buffett has millions of shares of Phillips 66 to the point where he's got a pretty significant ownership position and a lot of power with that company. But he spent hundreds of millions of dollars to get to that position. Okay, so most of us, it's not realistic to think that we're going to get some powerful position with a company of ownership based on the stock that we buy. You could buy thousands of dollars. You can even buy millions of dollars in some companies and still not have a significant ownership position in that company, which most people don't buy stock because they want a control position or want power. Most people buy stock just because they want the upside potential, or the total return potential of the stock increasing over time. Okay, so how do we analyze common stocks? The question we want to answer from chapter 7 is, if I was thinking about investing in stocks, okay, how do I go about analyzing one stock and comparing it to another stock, right? So there's thousands of stocks out there. There are thousands of companies that I could invest in. How do I choose which one would be best as far as an investment is concerned? And this is interesting because some of you in past weeks on the discussion board have been very candid about your, how do I word this, your dislike or distrust of the stock market and stocks, right? Or maybe a lack of confidence in your ability to pick stocks is a better way to put it, because some of you have said things like, if I were to invest in stocks, I'd just get an advisor or a broker because I don't want to, I have no idea how I'd even start. as far as choosing which companies to invest in. And to that, I would say that you're not alone. Most people, if you were to ask them, how do you choose one stock over another, even if they're stock investors, they might say something like, well, I just bought this company because it's a local company. I just bought that company because I read an article and thought that that company was cool. Or I just bought that company because the products are good. Like I like to go to Costco or Disneyland, so I wanted to invest in Costco and Disney stocks because they seem like good companies and I like to go to those companies. And actually, if you are a long-term investor, that type of investing is not bad, right? It kind of sounds like you're not putting a lot of effort into it, but companies that are busy and that have a lot of repeat business that you like to do business with and are growing, those are the kind of companies that in the end the analysts tell us to invest in anyway, and they're the ones crunching all the numbers, right? So this isn't so difficult that you should just, run away from the opportunity to invest in stocks. Analyzing stocks can be very complicated, but it also can be very, not very deep as far as the analysis is concerned, but still highly effective. If you're buying companies that are growing, that do a good job, that make their clients happy, you're probably in a company that's going to return good value to you over time. Okay? So that's kind of a preface that I wanted to get out of the way before we started with the actual content, because I don't want you to feel intimidated by, the thought that you've got to do tons and tons of research before you invest. It's just not the case. And like I say, a lot of very successful investors just invest with companies that they like and they trust and they like to use them and they think they're growing or they can see that they're growing. Okay, so what is security analysis, or what is analyzing securities or stocks? It's just the process of gathering information and then organizing it and then reviewing it and trying to determine whether or not it has the ability or potential to grow and return value to you. Okay, so bottom line, it's going out there, getting the information you need, doing what Jim Cramer on CNBC refers to as doing your homework, where you go out, you find information about the company, and then try to evaluate whether or not it's a good deal or not. So is it too late to invest? Do you mean in a particular company or story, or do you mean age-wise? You probably mean age, yeah. So Annette, as far as age is concerned, I would say no to that. I've got 90-plus-year-old customers that are still investing in stock or have stock investments. And I talked last week, when we talk about the risk-reward trade-off, we talk about how time frame is the key, right, to how much risk we should take. If you've got a 90-year-old person, they, theoretically, or at least on paper, they don't have a lot of time, right? They might pass away tomorrow. However, that person might be investing knowing that their investments are going to go to their children or grandchildren or to charity. And if that's the case, then it could be still a long-term investment, even though they may be passing away soon. So there's not really an age cutoff at all. Anybody, any age, there's no minimum age, there's no maximum age. Anybody of any age can invest in stocks, and anybody of any age might be suitable or might be right to invest in stocks. As a general rule, the older people get, the less likely it is that they're going to invest in new stock positions. Some people will hold stock positions long term. Like, for example, maybe your parents or grandparents might have General Electric stock, GE stock, or they might have ExxonMobil or Chevron or ConocoPhillips or something like that, and maybe they've held it for 20 or 30 or 40 years. And sometimes an investor will just hang on and then just give it to their children, right? So it's not like they're investing new stocks, and it's not like they're an aggressive investor necessarily. It's just they have stock positions that they've had for a long time. They like the companies, and they like the dividends, that they pay. And so they just hang on to those companies. But it doesn't mean that they're necessarily aggressive. Sometimes we think that in order to invest in stocks, you have to be really aggressive and risky. There are a lot of very conservative investors out there that hold stock in companies that they are very confident in and feel comfortable with and don't feel like they're being aggressive at all. So that was kind of a long answer to a short question, Annette. But the short is no age requirement, no cutoff. The long is there's a lot that goes into whether or not people invest in stocks or like to invest in stocks, and it just depends on the situation, right? So good question, though. Thanks for helping me understand that you're here. I appreciate that. So what do we talk about? What do we mean when we talk about intrinsic value? So what does the word intrinsic mean? And why do we talk about it when we talk about stocks? Intrinsic value basically is just referring to, after analyzing a stock, feeling like there's value beyond the current value. Okay, does that make sense? There's value or gain or a return to be had beyond what it's currently priced at. So if there's a company like Walmart, for example, that I expect the Walmart stock, this is just a hypothetical made up thing, okay? This is not what I really think. I'm just making it up for purposes of an example. Let's say I think Walmart stock is going to go down, the company's going to shrink, and over time the company's going to just end up bankrupting over time, okay? Just because they're going to become obsolete over the long term because they don't treat their employees well or something like that, okay? If I think that, then Walmart stock to me has little or no intrinsic value, okay? It has current value, right? But it has little or no intrinsic value because there's not the potential for future, in my estimation, there's not the potential for future returns. Then I might be looking at a company like, let's say British Petroleum right now, BP, okay, big oil company. BP is down significantly in value over the past few years after their oil spill and then because oil prices are so low. By the way, I got gas today for $1.68 a gallon. I feel really good about that. I'm glad oil is down, but it's also hurting the stock market and in turn hurting British Petroleum or BP stock. So let's say I invest in BP stock, and BP, I think over the next 5 years has considerable intrinsic value. Why? Because the price of BP is very low and the price of oil is very low. And I think the price of oil over time will actually go back up. And when that happens, all these oil companies will increase in value. So that's an example of a company that I feel like has significant intrinsic value right now. Okay? So that's just an example. So we want to find companies through our research, through our homework, that provide good intrinsic value, right? High intrinsic value. If I come across a company that I think is going to shrink or slow or stop growing, that's a company that I'm not going to feel has intrinsic value. The only way it would have intrinsic value to me if it's not growing is if it was paying a nice dividend, right? Because then there's some kind of value that can be had from owning that stock, even if the stock price itself doesn't move much. Okay. So intrinsic value depends on a lot of different things, as you can imagine. Some of the things you might not think about are, what is the discount rate? What is the rate at which, the stock or share itself is discounted? How much cash flow is the stock going to have in the future? And how much risk am I taking by buying this particular stock? Welcome, Novina. I don't think I said hi to you yet. I didn't see that you'd come on. Thanks for being here. So let's talk about how mutual fund managers and different managers of investments will evaluate stocks. So how do they do it? That's probably a good place to think about, because obviously how they do it is worth considering. They've had a lot of success. Mutual funds have been around for 80 years, and they're highly successful investment product. Many mutual funds have outperformed the stock market on average over the past 30, 50 years considerably. So what is it that they do? So how do they analyze the stocks that they put inside of a mutual fund? Now, first of all, when I go through this, I just want to give the disclaimer that most of these mutual fund companies have teams of financial analysts, meaning if I work for a company like American Funds, for example, out of California, one of the largest fund companies in America, or Vanguard Funds, or Fidelity Funds, there are hundreds of folks that are on the payroll at these companies that are analyzing these different companies. And sometimes more than one person their full-time job is just to analyze a certain company. Okay, they come into work every day, and for 8 hours, they analyze one company and all the information about that company that they can possibly find. And then they come up with what's called an analyst report, where they give their feedback and their opinion on whether or not it's a good buy or not. Now, mutual fund companies will usually do what's called a top-down approach, but there are also mutual fund companies that do bottom-up approaches, which would be the exact opposite chronology of what I'm about to tell you. Okay, so if it's a top-down approach, they start with the big picture, and they go to the individual company. If it's a bottom-up approach, they start with a group of companies, and they look at the information associated with those companies, and then they make choices in the end between the companies they think are best based on what's going on, with the economy. So let's talk through it a little bit more. It'll make more sense. So if I have a top-down approach to my analysis of companies, the first thing I'm going to look at is the economy, just the state of the global economy and the U.S. economy if I'm here looking at U.S. companies. So right now, things that would concern me would be the fact that globally there's what we refer to as a global slowdown or even a global recession in some parts of the world right now. So those things would be concerning depending on whether or not my company sold their goods and services to those other countries, how much exposure they have to international emerging markets. So those are things that the economy would help me determine other issues if I know where the economy's at and if I can gauge what the economy is going to do next, whether or not it's going to grow or whether or not it's going to go into recession. Okay, so that's where I start with top-down analysis. The next thing I do is I look at different industries. Industries, as an example, would be like the technology industry, like companies like Google and Apple and Netflix. And then I'd look at a different category like oil and gas, and that would be companies like ExxonMobil, ConocoPhillips. Or I could look at retail companies like Macy's, different big department store chains. Okay, so these are different categories, and I could look at those different categories, see where they're at based on historic standards as far as their pricing, their average pricing. That would be information that would be helpful. I could see what I think that industry is going to do relative to what the economy is going to do. So some of those industries do poorly when the economy's doing well, actually, and vice versa. And so it's good to know what the economy is going to do before I look at what the different industries might do in reaction to that. Then when I found my favorite industries based on what the economy is going to do, finally I look at fundamental analysis of individual companies, okay, within that industry. So I pick the direction I think the economy is going. Then I pick the best industries for that economy. Then, out of those best industries for the economy I think is going to happen, I pick the best companies based on my research out of those industries. Okay, it's kind of like a pyramid, right? Start at the top, I look at the big picture. Then I look at kind of the medium picture, the industry picture, and then I look at the individual companies and pick the best ones I can find based on my overall opinion of the economy and the industries that'll do best. Okay? All right, anybody have any questions about top-down approach? Do you feel like you kind of understand what they're looking at or how they're looking at it when they are evaluating companies to invest in a mutual fund? This is something that you and I can do as individuals. We can think about, okay, what do we think the economy is going to do over the next few years? Do we think it's going to go into recession? Think it's going to be bad? Do we think it's going to be volatile? Do we think it's going to be up? And we can read lots of economic reports on what the economy might do. Then, after we read all those reports, if we think the economy is going to be good, then we proceed. If we think the economy is going to be bad, we just don't invest. Okay, because in a bad economy, most stocks go down. Okay, in a recession, most stocks will go down. Think back to 2008, 2009. That was the last big recession we had. Stocks got clobbered. The recession before that was 2001, 2002. Stocks got clobbered. So if you think that the economy is going into recession, stocks are not a good place to be invested. Okay, but if you think the economy is going to be even just stable, doesn't have to be great, but even if it's going to be stable, you can make good money in stocks. And so you'd continue your analysis and go to industries that you think will do well, and then finally, like I say, to companies within those industries that you think will do well. Okay, so let me just give you a quick example. Let's say I'm an analyst. I think the economy is going to be very good over the next few years. I look at different industries, and some of the most cyclical industries that do even better when the economy is good are industries like airlines. Okay, and the fact that oil is low also speaks well to the airline industry because it's cheaper for them to fly their planes, right? Because fuel is by far their biggest input cost in flying us around the country. So I think the economy is going to be good. I think the airline industry is going to be especially good. So then I start looking at different airlines like Delta, Southwest, Spirit Airlines, some of the small ones, United American. So I start looking at these different airlines and I analyze each one of them, and then I decide which one or ones I like the best, and that's how I make my decision to proceed and invest in certain airlines. Okay? So that's a top-down analysis. Bottom up, we just start with companies and we go up the other direction. So let's talk just for a second about what it means when we say there's an efficient market. An efficient market, basically, when we talk about an efficient market, we're not just talking about a good market. A lot of times efficient and good are used synonymously. Like if I say, hey, Novena, you're working very efficiently. Usually that's a compliment, right? And what I mean is that you're doing a good job. When we talk about an efficient market, it's a little bit different. When we talk about an efficient market, we're talking about the concept that the market adjusts in real time based on all the available information. So what does that mean? It means that everything's priced accurately and correctly at any given moment. So if Walmart stock is worth $65 today, that's because Walmart stock is worth $65, and that's what it should be priced at, because everybody already has the information that they need on Walmart to evaluate and to price it correctly. Okay, that's what an efficient market would do. And advocates of efficient market theory basically say, okay, there's no way to time the market, there's no way to second guess or outguess the market, there's no way to be a good stock picker. And the reason for that is it's just all luck, right? If a stock goes up, it's because somebody got lucky. If a stock goes down, it's because they're unlucky. And a stock's only going up and down because of all the information that's out there. People use that information and price a stock accordingly. Okay? Now, reality is markets can be fairly efficient. They can sometimes be what we would think is very efficient, but a lot of times markets have inefficiencies. Okay, and what that means is not all the information that's known about a stock is really determining its value. And in fact, sometimes you've heard probably the terminology, a stock just becomes oversold, okay, or even overbought. So about a year ago, Elon Musk, who started the company Tesla Motors, who makes the electric cars that look nice and are really fun to drive. The Tesla owner, Elon Musk, basically came along and said at one of his quarterly reports, one of his investor conferences, he said, our stock is overpriced. He basically said that. Okay, and basically what he's saying is people are just too excited about our company. And you would think that's kind of crazy, right? To have a CEO of a company or the person in charge say, hey, you guys are getting too excited about this. Because most times CEOs are all about making us more excited about their company. But basically he was saying, hey, be cautious. Don't be crazy. Don't make our stock go way up beyond what it's really worth. Because if the market was efficient, Tesla would only be priced at exactly what Tesla's worth. But when you have the owner of the company saying you're overpricing our stock, there's something awry. There's something wrong with that. Let's see, is the PowerPoint working? Oh, I haven't changed it for a while. We're still talking about efficient markets. Is that where your slides are? Uh-oh. Then maybe it's not working. Let me go back and see what's going on. Can you see fundamental analysis is still important because? Uh-oh. What are you seeing on your screens? Oh, no. Hasn't been working this whole time. All right, let me back up a little bit. Thank you for letting me know because we've been going through a few slides here. Let's see here. Oh, just like it's caught on that first page, huh? Oh, don't apologize. I'm glad you brought it up. Thank you very much. Okay, are we seeing some slides? Sorry about that. Boy, you thought I was just rambling about one slide. That's pretty good on my part to be able to ramble that long about the chapter heading slide. Gotta hand it to me. That was pretty awesome. Yeah, so we have quite a few slides here we went through. We went through intrinsic value. Okay, we talked about that. We talked about top-down approach, the different steps from economic analysis, industry analysis, and fundamental individual company-based analysis. Talked about efficient markets. That's what we were talking about just now. And we talked about how even if we think that markets are fairly efficient, fundamental analysis still makes sense because there are inefficiencies that happen. And so one of the reasons why markets become efficient is because people do analysis. But a lot of times companies aren't efficient, markets aren't efficient, and that gives us an opportunity to find companies with high intrinsic value because they aren't efficient necessarily. Okay? That's why people invest. Then this breaks down the different steps. You might look at different economic measures like GDP, for example, gross domestic product, which is kind of a measurement of growth. Right now here in the United States, we're at about 2.3% annualized GDP, which means our country is growing in size by about, our economy is growing in size by about 2.3% per year, which doesn't sound like a lot, right? But as we discussed before, as long as it's growing, the stock market can do well. When it's contracting, when it's going negative, when the GDP is shrinking, that's when we have a recession on our hands, and that's when stock markets tend to do very, very poorly. Okay? So GDP is a key economic measure that we look at and pay attention to when we're trying to figure out whether or not we should invest in stocks or not. We look at a lot of different things in the economy, like fiscal policy, like taxation. Look at monetary policy. That's the Fed. That's Chairman Yellen right now, Janet Yellen. We see her on TV a lot if you watch CNBC, but she's the chairman of the Federal Reserve, and it's her job to change interest rates over time. She just raised interest rates for the first time about a month ago, and she's planning on raising interest rates some more this year. And as interest rates go up, obviously the economy will slow, and so she's got to be very careful how she does that. If she raises rates too fast, then we'll go into recession. So that's why people are so interested in what Janet Yellen does at the Federal Reserve. Okay, so that's monetary policy. And then you've got a lot of other factors like inflation and foreign trade and currency exchange. Right now, currency exchange is a big one because a lot of companies are not making as much money right now. They're selling a lot, but they're not making as much money if they're international companies because the US dollar is so strong. So if I asked 10 people on the street whether or not they thought the US dollar was strong, probably 6 or 7 out of 10 would say they thought it was weak, that the dollar was collapsing, that it was shrinking, that it was having a problem because of the headlines that we read sometimes that confuse us about that. But reality is the dollar has been very, very strong over the past few years and strengthening relative to almost every other currency in the world. And because it's strengthening like it has been, if you are a company like McDonald's and you have operations all over the world, when you go to take your money in those countries and bring it back into dollars, like convert it from yen, for example, in Japan, or Canadian dollars in Canada, and then turn them into US dollars, you lose a lot of money in that conversion because the US dollar is so strong. If you wanted to make money off that conversion, you'd want the US dollar to be weak, actually. And one of the things that China's doing right now to manipulate their currency is they're artificially making it weaker so that they can compete better globally with manufacturing. Okay, the weaker their currency is, the Chinese yuan, the weaker their currency is, the more manufacturing and more competitive that they'll be. Okay, so it's kind of a weird, you don't want the dollar to be too strong, it'll send a lot more jobs overseas. The weaker the dollar is, the more jobs will come back to the United States. So kind of a weird concept, but foreign exchange or currency exchange is a significant part of profitability that affects companies and the economy. Okay, so lots of different factors. We got a lot of different ones that goes over lots of them. Talks about the impact of each one and reviews that. Talks about where we can find information on these different components of the economy. Okay. So lots of different resources, and this is just a start. There are a lot more, okay, that you can find information about. My favorite that I look at every day and read articles on are just Yahoo Finance and CNBC.com. Okay, so I'm reading articles from both of those sites every day, multiple articles. A lot of them about the economy, but a lot of them about different companies, industries, all kinds of information that's helpful when I'm looking at investments and trying to help my customers. All right. Let me see what else we need to learn in this chapter. We might be about done with what we want to look at here. So it's breaking down how we look at different industries, how we look at different companies, some sources for industry information, ways, and we looked at this. This is something that fits right along with what we did this last week with the assignment. You all had to look up Starbucks information, and some of you found it easier than others. Some of you, I'm sure, were pulling your hair out trying to find that information. You kind of had to be patient about looking at all the different reports and trying to find that information, dig through the different reports and find the information. Most of you did very well at that. But the financial statements provide a unique opportunity for anybody to find out almost anything you'd ever want to know about a company's financial standing. So we looked up last week, we looked up Starbucks on just Google. We Googled it, and then we looked it up under Yahoo Finance to look at their financials, and we could look at their income statements, their statement of cash flows, their balance sheets, and anybody has access to that information. It's free information out there, right? Because these are public companies, they provide that information to all of us so that we can do our research and learn more about those companies. Example of a balance sheet, example of an income statement, and example of a cash flow statement. This isn't an accounting class, and so I'm not going to go into those. There's lots of different reports that we can find information, and some of you use some of those reports, maybe even unknowingly when you did your Starbucks assignment. Those different filings on that last slide, okay, like a 10K or 10Q, those are different reports that are filed for public companies that share a lot of information. Okay, let me just see. I think we're about done. A lot of financial ratios that are helpful in figuring out, just quickly how well the company's doing financially. Lots of different ratios, shows you how to get to the ratio, describes what the ratio means. Lots of different ratios to look at. Okay. Sources for ratios. Here's some, but I just like Yahoo Finance, Google Finance. They're the easiest ones to get to and to start looking up information. Gives you some examples. Kind of tells you about how to review them and whether or not there's some things that you can look to see if there might be problems on the horizon for companies. Because obviously if there are problems, we want to know about them, right? Okay. That's, I think, all we're going to cover from Chapter 7. I'm not going to even look at Chapter 8 with you, but I will post the slides. Okay. What we need to do now, though, is go to what you need to know for the test this week. As I mentioned before, there are 36 questions. They're all multiple choice or true false questions. Some of these questions, in fact, many of these questions, you'll recognize from prior tests, right? It's a comprehensive final, so you'll have a lot of repeat information. You'll have a lot of repeat content. And then, if I'm not mistaken, I think the last 15 or so questions, 10 or 15 questions are new from these last two segments, Chapter 7 and Chapter 8. Okay? So as I've encouraged you in the past, I'd take a few notes on these different topics. If it were me, I'd line a paper and just take a few notes on what I need to know for the test, so that I can do a little bit of research, a little bit of work before I get to the test and feel comfortable with it. Before we move on to that point, though, any questions about the content that we covered tonight about analyzing stocks and determining whether or not they would be a good investment? It's a lot of information, but I just wanted to throw some of the key points out there So in the future, if you were interested in investing in stocks, now you know how to do it, because we've talked about the simulators on Investopedia and other places. You know how you can practice doing it, like on an Investopedia. You know where you could actually do it if you wanted to, like on an E-Trade, Ameritrade, Scottrade, Fidelity, Vanguard, something like that. And you know about risk and reward, right? We talked about that quite a bit last week. Like you say, Marianne, it kind of builds off that quite a bit, building portfolios and risk reward. That was a very important investing concept from last week. And now this week, you know, if you did want to do your own research into individual stocks, now you've got some tools where you could look up that information and kind of evaluate for yourself what makes sense as far as what to invest in. Novena, you're not alone on thinking that these tests are hard. However, I actually got some feedback from the school this week, from the online school, and they were saying that they did have a student come to them in the last couple of weeks. I'm not saying it's anybody in my class, because there are 3 or 4 of these mods, so it might have been a different person in a different class, and basically said, hey, the tests are unfair because we don't have the ebook. And the school's response was, well, we made sure that between all the links that we put on the assignments, okay, so the links to websites, between all the checkpoints and the checkpoint information, that the students would have everything they needed to take the test and be successful. And I know that's a little bit unfair, because it's a lot easier to have an ebook where you have chapters of information and just go right to the chapter, right? But to their point, I do think that if we take notes from these sessions, the stuff that I cover, and then you very carefully read these questions, because sometimes what we might be getting caught up on or getting hung up on is just how the question is asked, right? Or how the answers look. And sometimes if we just take a little bit more time, slow down, don't give ourselves plenty of time to take these tests, read and reread the question, read and reread the answers, I think we'll be in okay shape. The average score to this point has actually been pretty decent, Novena. And so I'll go back when the class is over, and I'll actually curve your tests as a class if they're poor, right? If our average isn't at least a C or better on these tests, I'll curve them up. But in week 1 at least, and I haven't looked at the averages of last 2 weeks, but in week 1 we averaged a C or better. So I wasn't gonna be concerned about having to curve it up anyway. Marianne, good point. It does take a little bit extra effort when you don't have an ebook that's just really easy to go to right when you're taking the test, right? Takes a little bit of extra effort when you don't have that ebook like you don't in this class. Okay. Understood. Take a little bit extra effort on these, and make sure don't get tripped up by the questions themselves. Question 1 on the test is a repeat that you've seen twice before now. So this is your 3rd time. You saw it in week 1, you saw it on the midterm, and now you're seeing it again. And this question just refers to your understanding of what an investment is. Okay? Is an investment something that, well, an investment has to have an expected return, right? So if you put money somewhere that does not have an expected return, either growth or interest income, it's not an investment. If you put money somewhere that does have either interest or growth potential, then it is an investment. Even if you don't call it an investment. Let's give you an example of that. I might go buy a piece of art, okay? And the reason I bought that piece of art is because I think 20 years from now that piece of art is going to be worth more. Is that an investment, or is it not an investment? Anybody want to take a stab at that? I bought a piece of art, just a piece of artwork. It's not a stock, it's not a bond, it's not a piece of property, but it's a piece of art. And I expect that piece of art over the next 20 or 30 years to grow in value. Is that an investment, or is it not an investment? Yeah, it's definitely an investment. Anything that we expect a future return from is an investment. Anything that we get nothing from, as far as interest or growth, is not an investment. Okay? Okay, so be careful on that one on question 1. Even things that you think are just in your mind doesn't make sense that they're an investment, remember the definition. Does it create interest income or does it create any kind of value growth? If it has any kind of expected return, then it's an investment. If it doesn't have any kind of expected return, then it's not an investment. Okay? Putting cash underneath my mattress is not an investment, right? Because I don't expect to get any kind of growth on my cash underneath my mattress. But putting my money in a savings account at the bank, that would be an investment because I expect to get interest on that. Make sure you understand what is included. What are some examples of real property investments for number 2? Number 2 is also a repeat. If I'm not mistaken, this will be the 3rd time that you've seen it. So what are some examples of real property investments? And just know some basic examples before you get to the test and why they're examples of real property investments. Make sure you understand, once again, the definition of an investment. Something that gives you interest or investment return is an investment. Something that does not give you interest or investment return is not an investment. And that'll help you with number 3, which I think is also a repeat question. Number 4 on the test is a repeat question. It talks about the difference between mutual funds and exchange-traded funds, or ETFs. ETFs are one of the most popular investments of our day and are becoming more and more popular each and every day. So if you just understand that ETFs are very similar to mutual funds, you're halfway there, okay? Because that's a big part of the definition of an exchange-traded fund or an ETF is just, it's like a mutual fund, except one thing. Mutual funds only trade at the end of a business day after the market closes. And they only trade once a day. Okay, they reprice and trade once a day. Exchange-traded funds trade throughout the day. Okay, just like a stock does. They trade all day long. They go up and down all day long. So they don't just trade once a day, they trade all throughout the day continuously. Okay, that's the main difference between a mutual fund and an ETF. If you understand that difference, you'll get number 4 correctly. You'll get number 4 correct, I should have said. Okay, number 5 on the test. Make sure you understand the examples of institutional investors. We talked about institutions, government, and individuals, right? Were the 3 main categories from week 1. Make sure you understand the difference between those 3, right? It's pretty straightforward, but what are the differences between institutions, government, and individuals? Okay, or just give yourself a refresher before you get to the test and you'll be in good shape. Make sure you understand what we refer to as, what is debt, okay? And this came into play when we talked in week 1 about debt being the same thing as fixed income, being the same thing as bonds, okay? All 3 are a promise between 2 parties. One is going to let the other one borrow money, and the other one's going to repay it over time with interest, right? All 3 of those, fixed income, bonds, or debt, all 3 of those are the same. They're not the exact same thing, but they're the same concept, right? Make sure you understand what that concept is before you get to the test. Number 7 on the test and number 8 on the test are the concept of net demanders versus net suppliers of capital. This was a week 1 concept. You've seen these questions 2 different times. This will be your 3rd time. Out of those 3, individuals, institutions, and government, which ones are net demanders of capital and which ones are net suppliers of capital? Okay, make sure you understand that before you get to the test, and you'll get 2 more questions right, number 7 and number 8. Number 9 on the test, you just need to understand what trades on the securities market. What trades on the securities market, and you've got number 9 on the test. Number 10 on the test, you need to understand from a list of potential investments which one is most liquid. And we talked about liquidity being the availability of funds, right? How fast can you get your funds? But another concept that goes hand in hand with liquidity is safety. Because I can pull a stock investment out today if I need to, right? But it could have gone down dramatically today and I'd lose some of my money. So is a stock investment as liquid as a savings account? We'd say no. A stock, even though I can turn it into cash quickly, it might be down, I might lose my money, it's not as safe. So a savings account is more liquid than a stock, even though I can get at them about the same pace, okay? About the same quickness as far as money to cash. So when you're looking at a list of different investments, yes, number 10 is a repeat. You're just going to want to be able to identify the most liquid of the investment options that it shows. Number 11 is a repeat. Number 9. Number 9, you just need to know what trades on the securities market. What trades in the securities market? Number 10 is a repeat from previous week. It's going to list out some different investments and ask you to identify the most liquid. Which one has the most liquidity? Which one is most liquid? Number 11 on the test is a repeat from, I think, week 2, if I'm not mistaken, when we talk about costs of investing. Is the cost of investing with somebody on the phone more or less than the cost of investing online? Okay, if you understand the concept of online investing being much less expensive than talking to a broker either in person or by phone, you'll get number 11 correct. Number 12 is a repeat question, talks about the advantages of online investing. And we talked about a lot of different advantages in week 2. You'll want to review what some of those advantages are of online investing before you get to number 12 on the test, because it'll list some of those off and ask you to whether or not that's true or false. Okay. Number 13 on the test asks you to know the difference between descriptive versus analytical information online. Descriptive information is just information, right? It's the stuff we looked up on Starbucks. Analytical information is whether or not you should buy or sell that stock and the analysis behind it. Usually, analytical information is subscription service, is pay-for service. Usually, descriptive information is free, right? So if you understand that, then you'll get number 13 on the test right. And that's a repeat question as well. Number 14 on the test, once again, advantages and capability of online investing and online research. Basically, if ever you see on the test something about online research or online capabilities, it's true, right? There's just a lot of capabilities online. And the advent of the internet over the past 20, 30 years enhances everybody's ability to do research and everybody's ability to invest on their own if they would like to. Because prior to this, we had to use a broker, right? You had to use a broker, and brokers were very expensive. And now we have the ability to do our research, to do our financial planning, to do our portfolio construction. There's all kinds of things we can do in addition to the trading online. Number 15 on the test is a repeat question. It talks about when you're going in to submit a trade for a stock, whether or not you have some grace period where you can undo the trade. And we talked about how if you trade during the market hours, right, while the market's open, which is during the daytime, if you trade during market hours, you do not get a grace period. Once you hit submit, they're going to automatically trade it, and you're stuck with that stock. You either have to trade back out of it if it was a mistake, or keep it if you think that's the right thing to do. But there's not a trial run with it. Once you've hit the button submit, on a stock trade, you're in. Okay, no grace period, no do-overs. You have to live with whatever you did. If you made a mistake, you have to redo it, okay, or undo it. And you can't undo the trade, you just have to make it right. So if I meant to trade Disney stock and I actually accidentally trade ConocoPhillips, I got to go in and then sell my ConocoPhillips that I traded accidentally and then buy Disney, okay, which is a costly mistake, right, because I have to make 3 trades instead of 1. So we just have to be very careful about how we trade when we're trading online to make sure that we're accurate. And that's why I've mentioned this before, online trading sites will always give you a couple screens to click through and confirm before you actually execute the trade, because they want to make sure that you have every chance possible to confirm what you're doing. And that you should get that one right this time, right? No grace periods, no do-overs. You just have to live with whatever you trade and fix it. Not that you can fix the trade, but you have to sell whatever you bought and buy whatever you meant to buy. Okay? All right, so that was number 15. Number 16 on the test. This one is a repeat question. It has to do with stated interest versus real interest, or annual percentage rate versus effective rate. Okay? In business finance, we talk about effective annual rate. That's the rate based on how interest is compounding that we're actually getting on our investment. The stated rate is just the annual percentage rate. So if I'm in a investment that says I'm going to get an 8% annual return, okay, that's the stated rate. But if it's an investment that compounds on a daily basis, I'm going to actually get better than an 8% return. My effective rate is going to actually be higher. The same thing is true, though, against us when it comes to debt. On a mortgage, I might have an annual percentage rate that's the same as my effective rate. But on a credit card, they might tell me I'm paying 9.9%, but because it compounds daily, I might pay closer to 10.4%, something like that. Okay, so compounding interest and stated rates versus effective annual rates come into play with both debt and investments. They work to our advantage with investments. They work against us with debt. And if the compounding frequency is once a year, then the stated rate will be the same as the effective annual rate. If it compounds any more frequently than once a year, then those two numbers will be different. Okay? If you understand that, you'll get number 16 on the test right. Maybe a concept that will take a little bit longer than that 20-second spiel I just gave to understand, but you'll want to know the difference between APR and effective annual rate, EAR. Okay? They're not different if interest compounds once a year. They are different if interest compounds more often than once a year. Okay? All right, number 17 on the test. Just make sure you understand the definition of discount rate as it pertains to annuities. Okay? So you've got present value annuities, future value annuities, and you've got a discount rate. What is the discount rate? If you understand that concept, you'll get number 17 on the test right. Number 18 on the test, another discount rate question. So concept of discount rate is going to be giving you a couple questions. I think both of those are repeats from week 2, if I'm not mistaken. Discount rate. Make sure we understand what those are. We talked about a required rate of return. This is another repeat question. What increases or decreases the required rate of return? If inflation is high, I have to have a higher required rate of return. Okay, why? Because I got to keep up with inflation. If inflation's low, then I have a lower required rate of return. So if I have a lower required rate of return right now, okay, if the average person right now has a very low required rate of return, what does that tell us about what inflation is doing right now? Does anybody have a guess at that? Yeah, inflation is very low right now. That's why there's a very low required rate of return. That's why a lot of people are okay getting 0.2% or 0.3% in a bank account right now. Usually we would not be okay with that, and even most of us aren't okay with that. We don't like that, but we have to be okay with it because that's where interest rates are at, and that's where inflation is so low that we're not eroding our value too quickly. So the required rate of return is a function of where inflation is. If inflation is high, we have a higher required rate of return. If it's low, we have a lower required rate of return. That's for 19. Number 20 on the test. Number 20 is a repeat question about what taxes due to the rate of return on an investment. Okay. If I have a tax-free bond, for example, what we refer to as a municipal bond, I have a higher rate of, if all else is equal, if I got 2 bonds, one of them's tax-free and one of them's not, my tax-free bond, if the rates are the same, actually gives me more benefit, right? Actually increases my rate of return. Okay. So if I'm getting some kind of tax benefit from an investment, that usually increases or enhances my rate of return. If I lose that tax benefit, that will usually decrease my rate of return. Okay. So that's an important concept for number 20 on the test. Number 21 on the test is an exact word-for-word question that you had on last week's test about a portfolio is less than the sum of its parts. This was kind of a tricky question because there were 4 answers that might have been right, but one that was the most right. Okay, so this is one of these questions that if you read it quickly, you probably just answered A because it seemed like it could be right. But you need to read through all 4 of the answers and do the most right answer. Remember how we talked about the sum of the portfolio is less than the sum of its parts? We're talking about risk, and we're talking about how if we have more pieces, right, more stocks in a portfolio, we reduce the risk of that portfolio. We also reduce the average risk of the portfolio. So let's say the risk coefficient of all the different stocks in a portfolio of 15 positions was 1. Okay, remember how we talked about, well, I don't know that we talked about beta, but beta is a measurement of risk. and 1 is a measurement of beta. So beta is a way that we measure how much risk. Well, if all the stocks in a portfolio are 1, then somebody logical would come along and say, okay, well, the risk of that portfolio is 1 because all the stocks inside of it are 1. However, and why this statement is true, that the portfolio is less than the sum of its parts. The reason that's true is because actually in a portfolio where the beta is 1 on every single stock in the portfolio, the beta for that portfolio will be lower because of correlation, because of the fact that when you have low or uncorrelated assets, like we talked about last time, it actually decreases the overall risk of a portfolio while still accomplishing potential return that's good, in a portfolio. So that's the beauty of a portfolio. That's the beauty of diversification, is the fact that we lower our risk, we lower the average risk of that portfolio, and we don't necessarily increase our potential return, but we maintain a good potential return even though we've lowered our risk. Okay? So that's number 21 on the test, the concept of lowering risk through portfolios. Number 22 on the test, we need to know the definition of a correlated asset, a non-correlated asset, and a negatively correlated asset. Okay, negatively, uncorrelated or non-correlated, same thing, and correlated. Okay, so if we understand those three, you'll be good. Number 23 on the test, again, what's the point when we talk about correlated, uncorrelated, or non-correlated, and negatively correlated assets? What is the point of that conversation? What do those mean? How do they work in portfolios? And we showed you some different slides that showed how those correlations change the returns on a portfolio. Number 24 on the test, sorry we're going over time a little bit here. Number 24 on the test, I'll try to go a little bit faster. You've got risks that you can diversify, and you've got risks that you cannot diversify. Okay, so I can diversify the risk of individual companies by having more than one company, right? That's a risk that I can diversify. I cannot, however, diversify away from the risk of, say, taxes or inflation or acts of terrorism. Those are not things that I can diversify away from. Those are risks that are going to be in any portfolio I have, no matter how diversified I am. So you'll want to make sure you understand the concept of diversifiable risk and non-diversifiable risk and some examples of each. Okay. Number 25 is also in that same idea, the same concept, diversifiable risk versus non-diversifiable risk. Number 26. Number 26 is the concept of beta. Make sure you understand that the higher the beta is, the higher the risk is of whatever you're investing in. Okay, the higher the beta, the higher the risk. Lower the beta, the lower the risk. Number 27. Number 27 is an interesting concept. We kind of alluded to it last week, but I don't know that we covered it in depth enough for you to get this one right. Number 27 basically just says if you have an asset if you have an investment or a stock that you're going to add to a portfolio and it's high risk, okay, it's a high risk asset, does that mean that the overall risk of the portfolio has to go up? And the answer is no. It doesn't mean that, right? You can have a high risk investment that you add to a portfolio, and it can actually lower the risk of that portfolio. I alluded to this last week when I talked about the concept of bonds and stocks, right? Stocks are usually seen as more aggressive. Bonds are usually seen as more conservative. If you're trying to be conservative, you usually have a portfolio with more bonds. If you're trying to be aggressive, you usually have a portfolio that has more stocks. However, even in a very conservative portfolio, it makes sense to sliver in just a portion, 5, 10, 15% of stock. Why? Because that actually lowers the risk of a bond portfolio, because stocks are non-correlated assets with bonds. So you add in some stock to a bond portfolio, it actually lowers the risk. Even though stocks by themselves are more aggressive, slivering in some of those stocks actually decreases the portfolio risk. Okay, so if you understand that concept, you'll get number 27 right, which just says, it talks about adding high risk investments to a portfolio, whether or not that always means that you're going to increase risk. And the answer is no, of course not. It could actually lower the risk by adding that high risk asset, as long as it's not too much, right? If we add a lot, we're going to change the risk. If we add just a little, we might actually reduce the risk. Number 28 on the test talks about diversification. Okay. What did the slides say last week about diversifying into international companies? I don't think we talked about it, but the book and the slides are very clear that international companies are a good way to diversify. And if you invest in multinational companies like McDonald's that has a lot of operations overseas, that's a good way to diversify, but it's not the same as investing in international companies, because in international companies you get the benefit of different diversification of government, diversification of currency, all kinds of other diversification. Okay. All right, that's good news, Novena. Okay, number 29 on the test. It asks basically, should you understand all your portfolio objectives before you start to invest? Does anybody want to take a stab at that? Do you think you should probably know what your goals are for the portfolio before you start investing? Pretty straightforward, right? Yeah. So I didn't give you the answer, but you're right. Because it's pretty straightforward, pretty obvious. If you're going to invest, especially if you're going to invest in something aggressive like stocks, you should really understand what you're trying to accomplish, what your goals are, what you're trying to do with your portfolio before you do that. And it speaks to one of the things that we've already talked about before. When we talked about objectives of portfolios, you have income-focused portfolios, if you remember, and you have growth-focused portfolios, and then you have mixture portfolios where you've got growth and income. If you don't understand what kind of portfolio you're trying to create, you're not going to make the right choices as far as the stocks that go inside. So we definitely want to know our objectives before we start to invest in different investments. Number 30 on the test, make sure you understand what the capital asset pricing model is, CAPM. Capital asset pricing model. What is it? Why is it used? What is the theory behind it? Okay, what is the reasoning behind the capital asset pricing model, and what is CAPM? What does that mean? And you'll get number 30 right on the test. Number 31 on the test, okay, is asking you to understand what fundamental analysis is. We talked about analyzing stocks quite a bit tonight. What is fundamental analysis? That's where we look at individual companies and analyze their financials to determine their intrinsic value. Okay. Fundamental analysis, just making sure that you understand what that is before you get to number 31 on the test. Number 32 on the test, once again, just know what fundamental analysis is. Number 33 on the test. Number 33 on the test, we talked about different, we didn't talk about it very in detail, but there are some slides that talk about what has a negative or positive effect on stock values. There were some lists that I kind of clicked through. Go back to those lists in Chapter 7 on the slides and make sure you understand what negatively impacts stock pricing and what positively impacts stock pricing. And if you have a few of those that the text that the slides have, you'll identify them on the test and get that one right. Number 34 on the test asks about what the most important factors that influence a stock price is. Okay. You'll recall there were 3 that we looked at. One of them was future cash flows. Okay, it's that slide that had future cash flows is listed as one of them. Go back to that list, make sure you understand what those 3 were that impact stock prices. And if you understand what those 3 are, then you'll get the question right on number 34 about it on the test. Number 35 on the test is about dividends. When you're a good company and you go through a bad quarter, a bad financials for a quarter, you do not change your dividend. You try to keep your dividend as consistent as you possibly can as a company. The only time you change your dividend or discontinue a dividend is if you're in significant financial trouble, not temporary, long-term significant trouble. That's when you change your dividend. So if you understand that concept, number 35 on the test, you'll be in good shape. Good point, Novena. So Starbucks is in a situation where they've increased their dividend for a lot of years. If they go through short-term problems, they'll keep their dividend going. If they go through long-term significant problems and they're losing a lot of money, that's when they might look at discontinuing their dividend. But it's very rare for a company to discontinue their dividend or even change it in the short term. Usually they'll keep it going. even if it's hard to make it work. Just make sure you understand for number 36 on the test what the definition of required rate of return is. So what is the definition of required rate of return for number 36 on the test, and you'll get that one right. Sorry to go so much over tonight as far as the class. I think you're in great shape. You didn't get 33. Let me just tell you what that is. One sec. 33 was to make sure and go back and look at the list that explains the positive and negative impacts on stocks. Okay? Positive and negative impacts on stocks. I gave you about a dozen answers, Novena. If you were listening closely to how I worded those topics, you've got about a dozen. Out of 36 questions, you've probably got 12 of the answers based on how I just explained them. So you're in great shape. That's a great start. You've got 24 more. Out of those 24, you probably have, I'd say half of those are repeat questions, right? And then you've just got 12 that you need to do a little bit of research on. You'll be in great shape. So 36, what chapter is it from? It's required rate of return, if I'm not mistaken, was in chapter 5 or 6. And I'm sorry, I don't offhand, I can't remember which one it was. But I would just Google required rate of return. Find a good definition for required rate of return, maybe read a couple different places, and have it noted down in your mind so that when you get to the test, you'll be in good shape. Okay? All right, everybody, have a good evening. Wrap up the class strong. Get all your work in. Let me know if you have any questions or concerns or get stuck, but good luck to you. I hope it wraps up well, and make sure and be in touch if there's anything I can do for you. Have a good night. Thanks for being here.